Hello and welcome to the Steps to Investing YouTube channel. My name's Simon, and today we are very privileged to be talking to Laura Foll, who manages two investment trusts, or should I say co-manages two investment trusts, one being the Lowland Investment Company and the other being Henderson Opportunities Trust. We'll come to what that means and what a fund manager means in a moment. Just to say before we start though that today we are going to be talking about some companies, and that isn't a recommendation to buy, sell or hold that company. And of course it's worth remembering that all investment carries some degree of risk, and that investing doesn't necessarily mean that your investment will go up in the future. Well, I'd like now to welcome Laura Foll to the studio. Laura, hello, how you doing?
Morning, yeah, good, thank you.
Good. Now Laura is a fund manager on two investment trusts managed by Janus Henderson. So she co-manages something called Henderson Opportunities Trust and also something called Lowland Investment Company. So Laura, first question, can you explain to us what is a fund manager? What's a job description for you look like?
Yeah, so essentially what it means is managing money on behalf of clients. So in the case of investment trust, a fixed pool of money that you're managing with a particular objective in mind. So in the case of some of the trusts that I run, that objectives would be both growing the capital, so growing the pool of money, and also growing income for shareholders. So in the case of Lowland, we try and pay a really predictable quarterly dividend. So those would be investors that want an income stream from their investment as well.
So it could be typically perhaps a retired investor, somebody who's looking for a regular income, something like that.
Yeah, it really depends. So for Henderson Opportunities Trust, the objective of that trust is purely capital growth. So I think that would suit someone who's perhaps a bit younger with a much longer term time frame. So it really depends what type of trust you're managing as to who it would suit. But essentially it's always fixed pool of money that I'm investing on the client's behalf.
When you're doing that, when you're investing, what are you investing in? What are the kinds of things that you buy?
So the two trusts that I run would be UK only. So it'd essentially be investing in UK listed companies with the objective in mind. So for Lowland, it'd be a relatively long list of holdings. We'd have about 120 companies within there. They'd almost all be listed on the UK, a few Irish exceptions to that.
UK companies, essentially.
Yes, although the actual revenue would be often very international.
I was just going to come to that because obviously the UK company is listed on a UK exchange, so the London Stock Exchange, for example, don't necessarily get all of their money from selling stuff in the UK, right?
Exactly. So Lowland would be about 50-50 UK and international. That would actually be a lot more domestic than the benchmark which we follow, which is the FTSE All Share.
So just explain to me what a benchmark is. How does a benchmark work?
Yeah, so essentially a benchmark is a way of tracking our performance. So we in Lowland would compare ourselves to the FTSE All Share, and it's just a way of us saying each year, what have we done a good job? And if we outperform the benchmark, normally on a 3-year basis, because we're thinking long term in our investment decisions, then that would be a good thing. And if we underperform on a 3-year basis, that would be a bad thing. It just gives us a kind of title mark, if you like, to say, well, have we done well or have we done badly? But we're not tracking it. We're not trying to match it in any way. It's literally just a benchmark.
A comparison, essentially.
Yeah, essentially.
And the benchmark, you mentioned the FTSE All Share, essentially that's just a group of companies, isn't it? Just an index is the technical term.
So the FTSE All Share would be a mixture of the FTSE 100, which is the largest companies in the UK, the largest 100 companies, and the FTSE 250, which is the next 250 companies, and then a few smaller companies as well. But the vast majority of that FTSE All Share benchmark would be made up with the FTSE 100.
Companies. Yeah. And so what does a typical day in fund management look like? Is there such a thing as a typical day?
Not really. I mean, the average day for me would probably be coming into the office maybe 7, half 7. It would be looking at the company results if there are any and deciding what to do about those. Now generally we are long-term investors. The average holding period for Lowland is about 5 years. So I wouldn't normally trade around results, but when company results come out, I'll be sure to look at them just to check that they still fit our investment thesis. So that would normally be the beginning of the day, and then throughout the day I'd be spending my time sometimes meeting clients, sometimes meeting companies. Probably most of my time is spent meeting companies. James and I, who run the trust together, last year we met about 400 companies.
Wow.
So that's how we run it, that's how we pick companies to invest in. So it's really just churning through company meetings. James always says we kiss a lot of frogs. We meet a lot of companies that we don't want to invest in, but hopefully we pick a few within that we think, yeah, that's a really good company, I definitely want to invest in that.
And that company meeting will be quizzing the management about what they're doing, where they're going, how they're running the company, I guess.
Exactly. But it's not an antagonistic meeting. It's very much just getting to know the management, particularly in the smaller and medium-sized company area, which we invest quite a lot in. It's really important to know the management because there's not a big management bench behind the CEO and the CFO. So the CEO and the CFO are really driving that company, and so you need to have faith in them to run the company, because there isn't anyone else below them,
right.
and that's particularly in the small company area. So it's really important to sort of have trust in them, and that's why we feel it's really important to meet them.
Right. Okay. So thinking about sort of you in your job, how did you get into it? What was the motivation for being a fund manager?
There was no grand plan. I graduated in 2009, so it was in the middle of the financial crisis.
Right.
So it was literally a case of, I need a job. I'm going to apply for just anything and everything. I'd apply for law jobs, I applied for investment banking. And Henderson, at the time it was Henderson, not Janus Henderson, really thankfully did not cancel their graduate scheme. So yeah, I joined Henderson on the graduate scheme, and at the time, James Henderson, who I work with now, didn't have anyone helping him. So it was just very fortuitous that I kind of ended up with James and have been there ever since.
Right. Okay. And just thinking about what you've done since. One of the questions I get asked a lot when I meet first-time investors specifically is, what this idea of a fund manager. How do you become a fund manager? Presumably there's some training involved, qualifications. You can't just sort of turn up and do it, sort of thing.
Yeah, there's a fair few qualifications that you need, and you just do them on the job.
Right.
So, for example, the investment management certificate is the first exam you do. You do that pretty much straight off the bat once you join, and then you also do the CFA. Chartered Financial Analyst is, I think, what that stands for, and it's a 3-year exam. So yes, there's quite a few exams that you need. You don't just turn up and start managing money, because obviously there's quite a lot of jargon in the industry, good and bad, and you need to know what you're doing. You're managing money on behalf of other people. It's a responsibility, and so you need to have the qualifications before you do that.
I was going to ask you about that, of course, because you are managing, for private individuals, for institutions, and that must be a kind of weight to carry on your shoulders, to looking after people's money. How do you sort of deal with that, with that responsibility?
I think that was one of the first things in my sort of interviews for Henderson that people were trying to get across. I think you need to be the type of person that you will make mistakes in fund management, 100%. If you're getting things right 55% of the time, that's you doing well. So you can't be the type of person that if you do make a mistake, you can't come into the office the next day. You need to be the type of person that can withstand that and move on, as difficult as that can be, because I think as fund managers, we are all reasonably opinionated and we do like to think we're right, but a lot of the time we're not, and you have to be okay with that. And just, I think a huge part of it is just learning where you've gone wrong, and I think every year I'd like to think that become a better fund manager, because you learn, well, I won't do that again, that was a mistake. And I think that's why it really benefits me working with the likes of James, who's been there upwards of 30 years. So he's seen economic cycles before, he's seen the types of companies that don't make it through a cycle. And it's really important for me to have that guidance of him sitting next to me.
And I suppose that must be an aspiration as well, to be able to do that kind of long-term thing for yourself and have that experience to be able to look back and say that you've done it for 30 years and you've seen all those different things happen. Exactly,
it's really beneficial. So I came in 2009, and in autumn 2009. So at that point the market was already turning upwards after the crisis. So I've never seen, even though I've been here almost 10 years, I've never actually seen a recession, and I've never seen a proper bear market, and it's really important for me to be talking to James. So at the moment, at the time that we're filming, there's a lot of turmoil in the UK, there's Brexit, the markets are quite choppy, and it's really helpful for me to talk to James in times like this, because he's seen it all before.
I was going to ask you about that actually, because this, you're very much about your companies, what the company does, what's the prospects for the company. But how do you deal with that? I don't know if noise is the right term, but all of that stuff that's sort of happening around. I mean, Brexit's a really good example. At the time, as you say, the time we're talking, this is right at the top of the agenda in the UK. How do you sort of manage that stuff around the individual companies?
Yeah, I think it's an opportunity in a way. I mean, the UK or domestic UK companies are trading at a big valuation discount to the wider market. And what I mean by that is, as fund managers, we use valuation metrics just as a way of judging individual companies and seeing what value they are relative to the earnings the companies make.
Just the price you pay relative to what you think you're going to get in the future, essentially.
It's the price you pay relative to what the company is earning,
right,
effectively.
Okay.
And domestic UK companies, because of Brexit, because of sort of political uncertainty, are trading at a valuation discount to the wider market, because people do have that question mark about, okay, well, we don't know who the Prime Minister is going to be, we don't know where sterling or the pound is going to be. And that presents an opportunity for fund managers like us that are willing to invest in the UK for a period of 5, 10, 20 years, if you're willing to maybe face a bit of short-term volatility, some of those companies are really excellent companies that we want to invest in. So I think it's just trying to definitely listen to the noise and don't be sort of insulated from it. But if you can find a good quality company that we think is trading quite attractively, then just go ahead and buy it and just try and screen some of it out.
Yeah. We need to talk about risk, because there's no way that you can talk about investing without thinking about risk. How do you manage risk in your investing portfolio? Yeah,
we think the best way to manage risk is diversity. So for Lowland, we have 120 holdings, and we're trying not to run it on any thematic basis. So we're not saying, well, we think the US economy is going to grow next year and therefore we're going to invest heavily in UK listed companies that are exposed to the US. That's not how we run it at all. It's very much 120 companies. We're really aiming for those to follow different cycles within cycles, so that if and when there will be a recession at some point in the UK and globally, but we want these companies to be acting differently when that comes. So some will be, for example, biotech companies that won't respond to economic news at all. They'll just respond to their own sort of clinical trials and readouts and things like that. Some will be industrials, but within that they will have different cycles. Some will be exposed to aerospace, some will be exposed to defence, that kind of thing. So it's not any sort of hedging or anything complicated. It's literally just we hold a long list of companies doing different things.
So on a sort of scale of 1 to 10, are the companies that the investment trusts that you work on, are they risky or are they not risky? How would you assess the risk that you would be being exposed to?
As in the underlying companies or the investment?
The investment trust.
So I would say of the two that I manage, so Lowland and Henderson Opportunities Trust, Henderson Opportunities Trust has roughly 60% in AIM, which is a very small market in the UK. That would be riskier. AIM has less regulation than the main market, so we've seen some widely publicised failures on AIM. You've had Patisserie Valerie, you've had Conviviality, which was an alcohol distributor, effectively get written down to zero. So there is definitely a higher risk on the AIM market than there is on the main market. It's not to say the main market is not risky, it's just varying degrees of risk. So I would say of the two that I manage, Henderson Opportunities Trust would be the more risky, it would be the more volatile, and therefore that would be better suited for someone who's willing to put up with a bit of that risk, but maybe has a very long time horizon.
Okay. We've talked a lot about buying. How do you know when to sell? When is the right time to sell a company? Is there a right time to sell a company?
A more difficult decision, I think. The way we run money is quite valuation driven. So generally when we're exiting positions, it would be because we think they've reached what we think is fair value, or in some cases a bit too expensive. So it would be when that valuation multiple has crept up versus history or versus similar companies that are listed, and we think, well, that looks a little bit expensive now, time to move on, and maybe we'll hopefully find another company that is at an earlier stage that is more cheaply valued. So that, in an ideal world, that would be when we would move on. There will also be situations where the investment thesis that we thought we were buying into hasn't played out.
Right.
So maybe there's been more of a competitive backdrop than we thought. Maybe there's been cost pressures and the margins haven't been what we thought. There will be times when we get things wrong, and if that fundamentally changes the thesis, we just need to be upfront with that and move on. So there's a mixture of the reasons for selling. One would be kind of the right reason, where the reason we've bought the company has played out and time to move on, and sometimes we get things wrong and you just need to admit that and move on.
We've nearly run out of time, but I've got one final question for you. What's the best thing about your job?
Definitely meeting companies. We meet some really weird and wonderful companies. The first company I ever met was a salmon farmer. I learn a lot about salmon farming. Didn't think I'd ever learn about that in finance, but there you go. I just find that really fascinating, and I think part of me thinks it's a real privilege to meet company management, especially ones that have been very successful. I'm just a fund manager, and you're getting to meet these people that have really built up companies in some cases from scratch, and I just think that's hugely impressive. And it's a real privilege to get to meet them and get to know them and question them about it.
Laura, thank you for that. It's been a fascinating conversation, and thank you for spending the time. And thank you for watching. If you would like to catch up on previous episodes, they're available on the Steps YouTube channel. All that remains for me to say is thanks again, and we'll see you next time. Goodbye.